If you're thinking about buying or selling real estate, there are important trends within the metrics of our economy that you need to know about prior to making any decision. In this video, I'm going to illustrate and simplify these trends for you. This video will be important and informative for you. My name is Anton Bond. I'm a San Francisco Bay Area real estate agent. And today we'll be analyzing 3 decades of mortgage rates, inflation rate, median house price, stocks, as well as the unemployment. And we'll initially be looking at these metrics in their singular form. Thereafter, I will stack all of these graphs upon each other, creating one comprehensive graph. And it's within this graph is where I will illustrate and explain these trends to you. Now, for the sake of this analysis being fully comprehensive, I will also highlight each duration in which we've endured a recession. Now, with that being said, is that no one can accurately predict with a 100% certainty where any of these markets will be. But I get this question a lot from my clients is, what do I think the real estate market will be in the near future? And for the sake of giving them a prediction that is backed based off an analysis and as much information as possible, I do these analysis versus giving them a prediction based off a gut feeling. So with that being said, let's dive right into this analysis. Okay, guys, now let's establish a timeline. And we're going to go back into time, way back in time, back to 1993, where leopard skin print was a fashion statement and popcorn selling was still kind of a thing. There it is. Okay, now let's implement the era of recessions. Okay, so before we look at all of these charts piled up on each other, I think it's important to look at them in their singular form. All right, guys, here are the rates. Let's have a look. Look at this, 1995, wow. Rates surpassed 9%, that is very high. But let's take a look at the rate fluctuation during the times of recession. Look at this, dot-com recession and even the Great Recession, when lenders gave out loans to anyone and everyone. Even during those times, the rate fluctuation is still not as drastic as what we have recently seen in 2020, 2021, and 2022. Let's take a look at the stocks. Here's the Dow Jones. Why not the S&P 500 or another index? Well, I'll be the first to tell you that I'm definitely not an expert within the stock sector. I'm only an expert in a bull market. With that being said, I've recently watched an episode of Mad Money with Jerry Kramer, and in that episode, he specifically mentioned that the Dow Jones is more directly connected with the other metrics that we're going to be looking at in this video. With that being said, I'll go with his guidance. Let's take a look. Now, obviously, we have 3 recessions here, and take a look at the first 2 recessions prior to the COVID recession. The decline, the steady decline in the Dow is much more longer duration versus the COVID recession. Not sure what's going on, but perhaps we've learned something during the dot-com and Great Recession that we've implemented prior to the COVID recession, which prevented a much more longer duration of a decline in the Dow. Let's continue. All right, guys, median prices, let's take a look. Now, before we begin, and before all my clients in Silicon Valley and San Francisco Bay Area ask me, where can I get a property for $400,000? Well, here, as you know, it's quite different. Now, this graph is actually nationwide, so that's why you see these lower numbers here. Anyways, let's have a look. We have 3 recessions right here. And as you can see, 2 of 3 have 0 effect on the home prices. And I believe that the 2008 or the Great Recession had an impact on the home prices only because of that recession was caused by a factor that's directly connected and related to real estate. Now, it's very interesting to see no other impact regarding the other recessions. All right, people, let's talk inflation rate. This is a super smoking hot topic here in January 2023, and it especially was in late 2022, rightfully so. Take a look at this super sharp incline. Now, during the past 3 decades, we've never endured such a sharp incline. Obviously, there in the Great Recession, there was a sharp decline, but the incline likely has a larger effect on our economy. And we all know it is likely due to the mortgage rate. It's going to be very interesting later on in the video when we compare the other metrics to see whether or not those other metrics had an effect on this as well. All right, everybody, let's take a look at the unemployment rate. And I realize that this is likely a direct byproduct of one or some of the other metrics that we're reviewing, but for the sake of this analysis being fully comprehensive, let's take a look. This is very interesting. Take a look at the dot-com and the Great Recession. Now, after that, it took a very prolonged period of time for the unemployment rate to go back to pre-recession rates. Now take a look at the COVID recession. It took a very short period of time to get back to pre-recession rates. Very interesting. All right, people, we looked at these metrics in their singular form. Now it's time to look at them comprehensively in a multi-index chart. Okay, guys, here it is. And what a mess it looks like. Well, let's admit, stacking up all these graphs upon one another without any sense of vertical alignment may be a bit more difficult to decipher and analyze. So let's consider that in 1993, all of these metrics were at the most optimal position. With that being said, let's have them start at the same starting point in 1993. Okay, good people, let's take a look. Now that all these metrics are aligned and starting at one starting point, it's much easier to read and decipher it. And it's very interesting that during every recession here, there's a three-part chain reaction. And it all starts with the Dow. Let's have a look at the dot-com era. So when the Dow starts to decrease in 1999, what happens next is the inflation falls with a decrease, the unemployment increases, and then all those are followed by a mortgage decrease. Same thing with the Great Recession in 2007. The Dow decreases. What happens next? Inflation decreases, unemployment increases, subsequently, mortgage rates decrease. And it's the same occurrence here in the COVID recession. In 2019, Dow sharply decreases, and the inflation sharply decreases, unemployment sharply increases, and guess what? Drum roll, please. You got it. The mortgage rates decrease as well. So this is a very consistent trend here, and it's very interesting. And we could all see this, that the blatant distinction of duration between the COVID recession versus the Great Recession and the dot-com recession. Whereas within the COVID recession, it took a matter of only a few years for this chain reaction effect to occur and unfold. Whereas the Great Recession and the dot-com recession, this took a matter of approximately 4 years to unfold and occur. Okay, y'all, now let's take a look at the median house price, which is the primary reason why I'm doing this analysis for my clients and for you guys. So let's take a look, and we can clearly see that within 2 of the 3 recessions here, that the median price still continued to have this consistent increase regardless of what was going on with the other metrics, such as the stocks, the inflation, and the mortgage rate. And it's very interesting. And I believe, and I know that the reason why during the Great Recession, the median house price decreases is because what caused that recession there, those factors were directly related to real estate itself. Okay, now let's look at the durations outside of those recession eras. And we can clearly see that when the inflation rate and the mortgage rates are fluctuating at relatively normal levels, we see that the median house price is increasing at a very healthy level. Take a look. Between 93 and 1999, mortgage rates and inflation rates were fluctuating at relatively healthy levels. And there we have a consistent median house price increase. Same thing with 2003 and 2007. A relatively normal fluctuation of the interest rate and the inflation rate. We have a healthy increase of the median house price. Same thing between 2011 and 2019. All right, guys, that was very fun and informative as well, right? Now I'm going to momentarily direct all of my words to my clients as well as anyone else in our area. So earlier I mentioned that the median house price chart that we were looking at was on a national level, and that it was, and our prices are definitely different here. But when we look at the fluctuation within the median prices here, it actually is very similar to that of the fluctuation on the national level. Let's have a look. So I've added the median price chart here for Santa Clara County. And as I mentioned, you can see here that the prices are definitely different, but the fluctuation overall is generally the same. So here in the Bay Area, we've recently endured a very sharp decrease in median house prices. And from my perspective, I think it very much resembles that very sharp decrease that we had during the Great Recession. Now, recall earlier that we were comparing the durations that it took for things to unfold during the COVID recession versus the Great Recession and the dot-com recession. So we got to ask ourselves, looking at this chart, do you think we are at the very bottom of the median house price? Well, I'll tell you one thing, that this chart depicts a span of 3 decades. And when we look closer to what's happening today in the median prices within Santa Clara County, it actually tells a bit of a different story. Let's have a look. Okay, y'all, now what we're going to do is zoom in at more recent times. And instead of looking at the median price fluctuations within a 3-decade span, let's zoom in to, let's say, 2018, past 5 years, and see what that looks like. This is the MLS listings. It records every home sale that's been done on the market. We'll go directly to stats. We'll customize this to a custom time frame. We'll do January 2018. December 2023 hasn't happened. We'll change that to January. The statistic we're going to be looking at is sale price median. We'll group this by month. And for the sake of being comprehensive, we'll select all 3 main categories of property type. We'll specify the county. Let's do a line chart because they're cool. Let's generate that. And here's what we get. See, that drastic decrease that we've seen on that 3-decade chart is pretty drastic, but it doesn't seem so scary here, right? Let's zoom back out and I'll show you that drastic decrease there. You have 1.6 in April of 2022 to a 1.3 in December of 2022. Let's zoom back in. There it is. We'll generate that. Okay, so about my prediction. Let's go back to the comprehensive graph here. And let's also recall the chain reaction that occurs after the Dow decreases. Now, what I'm going to do is attempt to draw what is going to unfold within these metrics within the next 3 to 6 months. Okay, let's look at what has occurred within the chain reaction that has occurred within previous recessions. We have a decrease in the Dow, and we have, just like clockwork, thereafter a decrease in inflation. What hasn't occurred is an increase in unemployment and a decrease in rate. So here in January of 2023, is it a coincidence that we are reading a bunch of headlines regarding a bunch of layoffs? Okay, so now I'm going to draw what I think is going to happen within the next 3 to 6 months. And specifically within Santa Clara County median house price, I think it's going to look something like this. Today, the Santa Clara County median house price overall between the townhouse, condo, and the single family, today we're about 1.3. And I think within Q2 and Q3, that is going to bump up to about 1.5. So there you have it, my prediction. Okay, y'all, thank you very, very much for tuning in, and I hope this analysis has been very informative for you guys. I conduct these analyses on a regular basis, but this is the first time I've recorded it, so I'm very eager and happy to share it with you guys, especially my clients. And if you or anyone you know has a question regarding real estate or just would like to discuss your real estate goals, feel free to send me an email or a text message or give me a call. I'm always happy to connect with people. And remember, in real estate, there are no out-of-the-box solutions typically. So with that being said, thank you very, very much for watching. I hope to talk to you real soon.